All right, hello everyone. My name is Francesca Jean-Baptiste and I'm the Director of Tax Partnerships at the Cash Campaign of Maryland, and I want to welcome you to the Small Business Tax Bootcamp. If you're an entrepreneur, a freelancer, consultant, independent contractor, or sole proprietor, whatever you call yourself, this is a class all about taxes and it's just for you. Before we get started, I want to invite you all to please register and join the other virtual Money Power Day exhibitor booths and/or workshops if you haven't done so already. We've got a lot of great folks here with a lot of great information for you, so make sure that you check them out, okay? Also, I want to encourage everyone to use the chat. Although this is a pre-recorded session, I am going to be here with you answering all of your questions during and after the session, so make sure you keep those questions coming. All right, let's get started. So here's our agenda for today. We've got a lot of meaty topics to cover: business basics, small business taxes, the importance of record keeping, tax preparation and the letter C, estimated tax payments, and of course, our top 10 tax tips. So first things first, business basics. Do I even have a business? You may not know that, but this is a very key feature. Distinguishing a hobby from a business really boils down to the motivation to turn a profit. The bottom line is, am I in this to make money? Okay? And whether you actually do make money or not is not really that important. It's really all about intent. With a hobby, this activity is done mainly for recreation, sport, or personal enjoyment. The prime motivation here is not to generate an income. Whereas a business, which is the carrying on of any trade, service, or activity, is for profit or with a profit motive, okay? So the main objective here is to make money. And why am I talking to you about hobbies, actually? Got ahead of myself for a minute, but it's important to know that this distinction exists because businesses are able to enjoy the ability to deduct qualifying business expenses during tax time. And I'm sure you've heard the term write it off, right? No other words are more powerful to a small business than the ability to write something off. Well, you can only do that if you can establish that you have a business. With a hobby, you are not able to do it. That ability to write things off goes poof into thin air. It just disappears. Years ago, you might have been able to deduct any hobby expenses on your Schedule A if you itemized at tax time. However, the Tax Cuts and Jobs Act of 2018 eliminated your ability to do that because it eliminated miscellaneous deductions. So if you have a hobby and you have any expenses or losses, you aren't even able to write those off or deduct those qualifying expenses anymore. So establishing a business profit motivation has never been more important, okay? You don't want the IRS to deem your business activity as a hobby because, again, you won't be able to take any of those qualifying business deductions on your tax return, okay? So establishing a profit motive, that is super, super important. There is a safe harbor rule that says if a business isn't profitable in 3 of the last 5 years, it's presumed to be a hobby. And that used to be business as usual with the IRS. However, there's a safe harbor now that if you have at least 3 years of profit in the last 5 years, you will be considered a business. My take is don't take any chances. Make sure that you're establishing that you have a business and that there's a profit motivation so that you can be sure that your business expenses are going to be allowed on your tax return. Still not exactly sure if you're a business? Here are some questions to consider. Do you create a product or provide a service for a fee that you keep for yourself? Do you earn money on the side that you keep for yourself, even if it's only part-time or a few hours a week? And do you receive the total payment for your work without any taxes taken out of the money you receive? If you can say yes to any of these questions, then the likelihood is that you are a small business, okay? So there are a couple of different entities that we are thinking about when we think about small business. The most basic one is a sole proprietorship, okay? This is when someone just hangs out their shingle. It's an unincorporated business that's owned or run by one individual with no distinction between the business and the owner. So you're going to see here independent contractors and freelancers. If you're a platform user, so you're someone who does Uber, Lyft, Instacart, TaskRabbit, any of those, you're essentially a form of a sole proprietor. There's that as a sole proprietor, the owner is entitled to all of the profits and is responsible for all of the business debts and losses and liabilities, okay? The business itself is not taxed separately. The sole proprietorship's income is considered the owner's income, okay? And this is going to then carry over to their own personal tax return as on a Schedule C form, okay? Which is something that we're gonna talk about shortly. A limited liability corporation is a little bit different, okay? This is a hybrid type of legal structure that provides some liability advantages of a corporation, but the tax advantages of a partnership or a sole proprietorship, depending on who owns it. The owners of the LLC are referred to as members, and this is an entity that is dependent on state designation. Maryland is a state that does allow sole owners, so one person, to own a limited liability company. And what's really important about these LLCs is, as I said, it provides some shielding of liability should anything go wrong. Whereas in a traditional sole proprietorship, the owner is responsible for any liabilities that happen. The LLC provides some of that shield. But when it comes to tax time, the LLC is a disregarded member. So you kind of stop thinking about the company in and of itself, and everything passes through to the owner and then is recorded on someone's tax return as they normally would a sole proprietorship. So it goes on the Schedule C as well on that person's tax return. And again, this is only for single member LLCs, so owned by one person. Where there are multiple owners or members of the LLC, then those things are taxed as partnerships, which is something we're not going to cover today. And just before we get started, I do want to mention that all the information that we're going to talk about today is really going to focus on those micro businesses. So businesses that are owned by one person. Okay, so we're not going to be talking about corporate taxes or anything like that in this workshop today. We're just going to focus on sole proprietorships and single member LLCs, where everything is treated as a pass-through entity. Okay, all right. So on with the show, small business taxes. So again, whether you're an independent contractor or a freelancer or a platform user, you are technically a form of a sole proprietorship. And even if you're a sole owner of an LLC, it's a pass-through entity. So again, it's going to be treated as the owner's as the owner's profits and losses and assets and liabilities. So what does that mean? It just means that when it comes to tax time, the most important thing to know about is the self-employment tax. And what is a self-employment tax, you ask? Well, it's an additional tax that sole proprietors, independent contractors, freelancers, and sole owner LLCs must pay to the federal government to fund Medicare and Social Security. Self-employment tax is due whenever there is over $400 in self-employment income throughout the course of the year. And basically, because the business is considered as self-employed individuals are considered as working for themselves, they contribute both the employer and the employee portion of the tax. Okay, so again, when you're in business for yourself, not only are you the owner, but you're also the employee, so the person that works for the company. So you've got the employer and employee portion of tax. And if you've ever worked as an employee for someone else, you might have noticed on your pay stub that there's your gross and your net income, and then you'll see that there is a difference between those two numbers, and part of that has to do with Social Security and Medicare taxes. But as an employee, you're only paying one half of that tax. Your employer pays the other half, which is the part that you don't see. But when you are a small business, you're working for yourself, employer and employee portion of the tax has to be paid by you. So how much is that tax? What does it cost? So first, self-employment tax is calculated according to the net income from the business. So all the income minus any qualifying expenses or write-offs. And we'll talk a little bit more about that later, but it's really based on the net income from the business. And for 2020, and actually for the past couple of years, the self-employment tax rate has been 15.3%. In total, it's 12.4% for Social Security and 2.9% for Medicare, okay? So the total is 15.3%. So think about it like this, and we're going to talk about how to calculate business income simply. But if you have a total of $10,000 in income for the business, but then you have $2,000 in qualifying expenses, well, then you've got $8,000 as your net, and your self-employment tax is going to be 15.3% of that $8,000. Okay, so not the total income, but what's left over after you've deducted those qualifying business expenses. So business expenses are very important. Okay. And so another really, 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 really important part of us having a small business is record keeping, okay? It is really, really important to make sure that you have a record keeping system in your business. And why, you ask? Well, here you go. The benefit to you, number one, it's required by law. You have to keep records. Number two, it shows your business's income and liquidity, so how quickly you can get cash. It indicates how much it costs to run the business. A lot of times people don't realize that they're actually spending way more on making sure that the business goes. And it also shows that the business is profitable, okay? So without records, you won't be able to see what you're bringing in and what you're putting out. And lastly, it is so much harder to recreate records later. You may miss some expenses. I cannot stress how important it is. You know, tax time is based on this 4-month period that looks back at the year before. And so you really, really have to make sure that you have all of your records, because it's hard enough to realize or remember what you did last week. So think about, what were you doing last year? What were you doing in, you know, October of 2019? Can you remember exactly? No. Well, maybe some people can, but it's just harder if you have to think about it, because it's just, you know, at least a year later that you are putting everything together for your taxes. And if you don't have the records to remember, you're really setting yourself up for failure. You don't want to make any of those mistakes. Now, what about the benefits to your business? Well, again, I can't stress hard enough, it's required by law. The Internal Revenue Code says you have to have records. But also, if you are ever at a point where you want to grow your business and you want to approach a financial institution for a loan, you're going to need records. They're not just going to take your word for it. Also, it really helps to separate your business income from your non-business income. One of the things that IRS auditors always want to look for is the commingling of funds. You want to make sure that you don't do that, and records can help you indicate that you haven't been commingling any funds, that you have separate income for the business and separate personal income. And again, good records will ensure accurate tax preparation. You won't have to be roving through, you know, different files or looking around your house to try and find that gas receipt or that invoice from, you know, March 2019. You already will have all of that stuff, hopefully, together. So your accountant or whoever does your taxes, if it's us at Cash, we will absolutely be thankful if you have records so that we can make sure that we're providing you with the best and accurate tax preparation that we can provide. All right. Record keeping 101. So the burden of proof is on the business owner, so you, to show all of your income and expenses, okay? So you have to be able to say and show where you put money out for expenses and where you brought income in for your business. It's your burden. Business records must be available at all times for IRS inspection. You know, in pre-coronavirus times, the IRS would just show up and say, hey, we want to see your records. You know, it doesn't happen as often, but it did happen in the past. That is obviously being limited, but you know, you never know, it could happen. So you want to make sure that you have your business records and they're available for IRS inspection, even if the likelihood of them not showing up is 100% or 99.9%, you want to be prepared for that 0.1% that they might show up. There's also no specific requirement on types of records to keep, except for there are a few exceptions. So some categories like meals and travel expenses do have some more specific record keeping requirements, but for the most part, you can have whatever system you want as long as it is able to prove and show accurately all of the income and expenses of the business. So again, keep in mind, in most cases, the law does not require any specific kind of records. You can choose any record keeping system that suits your business, but it must clearly and accurately show income and expenses. That's really kind of your guiding line. And the system should also be sure to include a summary of different business transactions. You want to be able to show where things are going and where things have come from. So helpful records really include, at the minimum, these things. So it's a brief description of the business purpose of the transaction, the amount, the date, and whom you paid or who paid you. So again, at the very, very minimum, you should be able to clearly identify these 4 things for each and every income and expense in your record keeping system. So good rules of thumb. Reconstruct immediately. So if, let's say, you didn't get an invoice from a client, someone just paid you cash, or you paid for something in cash and they didn't give you a receipt, reconstruct immediately. I cannot stress this enough. Again, you want to make sure that you have all of your records. And if you don't, reconstruct something, the actual ability to do that much later decreases with every day that goes by, because you will forget. So you want to make sure that you reconstruct immediately. You want to keep up-to-date records. Again, I can't stress that enough. You have to track your business income. A lot of businesses make the mistake of thinking that if the IRS comes and wants to look at your records, that they only really care about your expenses. That is not true. The IRS also wants to see your income. That's the first thing they actually look for. So you want to make sure that you're keeping track of all your business income, especially if it's cash, especially if you do not get an invoice from someone. You want to make sure that you track your business income. Save and organize your receipts. I cannot stress this enough. You got to have your receipts, your records in order. Also, you want to review your records often. Again, don't just wait until tax time, because tax time is a year later when you are reviewing your records. You want to be on top of that stuff. Good business owners are looking at their records all the time and often because they want to know what's going on in the business. Are you making money? Are you losing money? Are you paying too much for something? You want to track your time because you want to see if you're spending too much time on a certain thing within your business. If you're spending a lot of time on bookkeeping and managing your records, maybe you might need a bookkeeper. If it's too much for you, you never know. You might want to reach out to get someone else and some paid assistance to help you work on that, because record keeping, bookkeeping, that stuff is really, really important. A lot of businesses do end up in trouble because they just, spend a lot of time on doing the thing that is the business. So if, for example, if you're a graphic designer, maybe you spend a lot of time doing the business, right? Making graphic designs for clients and things like that, but don't manage the back end of the business, the bookkeeping part. And that's where people run into a lot of trouble. So you want to track your time and make sure that there are different, places where you can save some time where you might need to outsource. It's really important for you to do that. You don't want to sacrifice one thing for the other, because then the whole thing might end up being sacrificed. All right, so possible systems. So there's a whole range of things and ways you can do this. So you can have Excel spreadsheets, my personal favorite, I love Excel, QuickBooks, or any other software like Peachtree. You can keep receipt books, you can have mileage log books, a general ledger system. You can get them at the store, or from any place that sells office supplies, or you can use an envelope system. One of the most organized clients that I've worked with was a woman who had an accordion folder for every year, and she would put all of her receipts and all of her invoices in an envelope for every month, and she put it in her accordion folder, and that was it. And that woman could tell you exactly how much she brought in every single month, and how much she put out in expenses. It worked for her. So you want to remember that your system only needs to be as high tech as you need it to be. It just has to be a system that works and makes sense to you, so long as it clearly breaks down your income and expenses. So again, if the computer is not, if Excel is not your jam, don't use an Excel spreadsheet. There's a million things that you can use. You can use you can use the accordion folder system, the envelope system, a general ledger, whatever works, but you have to be able to use it. Because again, if the IRS does have questions for you, they are going to want to see your records. And if you have a fancy, sophisticated system that you don't know how to work, that's not going to help anybody, okay? So it's got to be a system that works for you. So it only needs to be as high tech or low tech as you need it to be. What about apps? Of course, there are a million apps that you can use to help you organize your records. So we are not promoting any of these or saying that any of these are better than any of the other ones that are out there, because I know that there are a million apps out there, but I can only fit so much on a PowerPoint slide. But here are just some of the ones that we've worked with, that we've seen clients use. So Expensify, QuickBooks, Stride, there's Concur, Shoebox, MileIQ if you do a lot of driving. You know, again, these are just a small swath of what's out there and available. Some are free, some you need to have paid subscriptions, but you know, if you have a touchscreen phone, if you got a smartphone, then you can definitely help keep your records all in order, because these apps are available to help you do that. All it takes is your camera, you take a picture of a receipt, and then you can throw it in the garbage or light it on fire, whatever you do. And that record is already recorded, it's in your system, it's got all the information that you need, usually date, transaction. You might have to type in the business purpose or whatever, but for the most part, you can be rest assured that that record is being recorded somewhere. And so when you need to go back and look at you know, the printouts or the you know, whatever comes out of these apps, these worksheets, you will have all of your records in one place. So apps are a really good thing to use. It's really, really quick. You just, you know, snap a picture and then you can forget about it, right? You don't have to think about where that receipt is going to end up, you know, as long as everything stays in the cloud, right? All right. So moving on to tax preparation and the letter C. So do I need to file taxes? The answer is yes. If you're a small business owner, again, whether it's independent contractor, freelancer, a platform user, or sole proprietor, or a single member LLC, there may be legal penalties if you don't file taxes. So you don't want to get on the wrong side of any of these things, okay? You want to make sure that you file your taxes. Also, taxes help you to track your income and expenses, because at the end of the day, once you've input all of that information into your tax return, you get to see what all your gross income was, what all of your expenses were, and you'll get to see if your business, you know, made any money or if you had some losses. Although this shouldn't be a surprise to you at tax time, because again, you should be looking over this stuff on a more regular basis than just at tax time. But, you know, it definitely helps to show you what's going on in your business. If you file taxes, you might be entitled to certain refundable credits. There's the earned income tax credit, for example, if you do work but don't have very high income, and you could help get some of that EITC as a part of a refund. Sometimes that works, not always. Again, there's an income cap for the earned income tax credit, but there might be other refundable credits that might be available to you as a small business owner. Most importantly, you'll pay into your Social Security account. You know, when you pay taxes, when you paid your self-employment tax, you're hoping to fund your Social Security for when it's time for you to use it. And then having accurate tax records can help you buy a home, get a loan, and ultimately sell your business if that's something that you want to do in the future. No one's going to touch you if you don't have tax records on hand. So you want to make sure that you have your accurate tax records, because again, if you need to get a loan or if you want to buy a home, they're going to want to see all of that stuff. Okay, so you got to file your tax return. You know, we've come across a lot of small businesses who say that they were, you know, overwhelmed and that they couldn't file and they didn't know that they should file their tax returns because, you know, they were a small home-based business. You got to file your tax return, okay? Small businesses have to file their tax returns. All right, so how do you calculate business income? Well, the easiest way to think about it is the gross receipts, so all the income from the business minus any of your qualifying business expenses, which will either give you a net business profit, put you in the green, or the net business loss, which will put you in the red. So that's kind of the easiest way to calculate your business income. Where do you find business income? So for this year is going to be the Form 1099 NEC, or non-employee compensation. That's going to be a new form that is going to be issued whenever there's been, you know, over $600 in self-employment income by, you know, you, the owner of the business, from, you know, a person or organization that you may have done a job for. They'll issue you this form. This form is going to replace the 1099 miscellaneous. The 1099 miscellaneous will still exist because it's really a miscellaneous form that reports a bunch of different types of income, but it used to be 1099 miscellaneous box 7, that employee non-employee compensation, but they did away with that box, and now it has its own form. So if you haven't seen it yet, because it's for this year, it's coming down the pike, 1099 NEC. So you shouldn't get a 1099 miscellaneous anymore. So 1099 NEC is the new form. Or you might have a 1099K, which is payment card and third-party network transactions. So if you get paid, you know, via Venmo or PayPal or any one of those things where there's a third party involved in receiving payment, you'll get a 1099K. Although those are usually only issued if you have more than 200 third-party network transactions, or if you have $20,000 or more in transactions. So you might not get any of these forms, right? Because there's a $600 limit for this one, and then there's a 20,000 or 200 transaction for the other one. So it's really important to keep your own receipts and records so that you are accurately able to say, this is the income that came in for me, and you don't have to wait for these forms, okay? Because a lot of times you might not get them. We've seen a lot of Uber and Lyft drivers who, you know, have done a lot of work for those companies, and they're considered to be small businesses when it comes to tax time, but they don't get any of these forms because of the way that those entities have chosen to record these payments. But they still have to report that income to the IRS. You still have to file a tax return, but they don't have any forms. So that's a problem. So you want to make sure that you have your own receipts and records so you're not waiting around for any of this stuff. I mean, it's always good to be like, you know, get these forms and say, oh yeah, this matches exactly what I have in my books. That's great. But in case you don't get any of those, you want to make sure you have your own receipts, your own records, that you are keeping track of your business income. Because even if you don't get any forms, you still have to report it to the IRS, okay? What about business expenses? So this is what folks always want to hear about. How can I write things off? Well, the only business expenses that are considered qualifying and therefore able to be written off are those that are ordinary and necessary to operate a business. And those words have special meanings. So ordinary means that these are expenses that are usual and common in the course of the business you run. And necessary means that you need this thing, you know, whatever it is, to operate your business, okay? And then so ordinary and necessary are really the most important words. That's your yardstick by which you measure your expenses by. But then there's also like a small little asterisk that says reasonable. Your expenses have to be reasonable, okay? So, you know, you want to make sure that if you are, let's say, a carpenter, that you are purchasing, you know, all the things that you need for your carpentry business. So that makes sense. So if you buy nails, if you have a hammer, if you're buying, you know, sheetrock or any of those things, that makes sense, right? But do you need a gold-plated hammer? You know, do you need gold-plated nails? Probably not. The IRS will probably look at that and be like, that's not reasonable. So you want to make sure that, that your expenses are ordinary and necessary, but also reasonable. Okay, that's the yardstick. There are lots of common business expenses. You can really argue that anything under the sun, as long as it's necessary and ordinary, can be used as a business expense, but here are some of the most common ones. So advertising, equipment, legal and professional fees, if you rent some space, if you have office expenses, paper and, you know, pens, copy machines, if you need to have a specific license, professional license to do the work that you do, if you have to travel, if you have to pay for some contract labor, if you have, you know, any employees, if you have telephone expenses, tools, software, continuing education, all of that stuff, as long as it meets the ordinary and necessary, and don't forget reasonable requirements, you are able to use that as a qualifying business expense and therefore able to write it off on your tax return. So let's talk about some of the most important ones, or the easiest ones to find. So business car and truck expenses are always a good way to go, especially if you do a lot of driving. So for our Uber and Lyft drivers, that's a really big expense for them. So there's two ways to deduct: the standard mileage rate and the actual car and truck expenses. One is easier than the other. You might have guessed it, standard mileage rate, SOUP, is much more easy. Basically, you figure out how much you drove for your business and you multiply it by the standard rate, which changes every year, and it's set by the IRS. So for 2020, it's 57.5 cents. And all you have to do is multiply that by the number of business miles that you drove. You can add just a few things to the standard mileage rate, so parking fees, tolls, And if you drive your vehicle for both personal and business use, you are able to add the business portion of an auto loan or the business portion of personal property tax on the car purchase if it's based on the car's value. But other than that, you can't add anything else to the business mileage rate, because the idea is that everything that you are paying for, so gas, oil changes, repairs, all of that stuff is rolled into this 57.5 cents standard mileage rate. So nothing else to be added. Now, actual car and truck expenses means you get to keep track of every single thing that happens with your car. So car washes, garage rent, gas and oil, tires, vehicle repairs. But if you also use your car for business and personal, you have to figure out which percentage is business, and only the business percentage is the part that you are able to deduct. And then again, you have to keep track of every single receipt, because you need to keep track of all of the things that happened with your car. Whereas standard mileage rate, you don't really have to worry about it. The home office deduction. So a lot of folks are always asking about the home office deduction. Basically, this is where you use a portion of your home for your business. This one isn't super easy to get because there are two requirements for this. You have to use that portion of your home regularly and exclusively. So regularly means often, right? So once a week, once a month, you can be expected to be there. And that's usually not the problem. The problem is the exclusivity. So I'm sure that there are, especially in these times, there is a portion of our home where everyone is basically doing work right now, or might be doing work. But the thing is, you can't do anything else but work on the business. So if you're using a kitchen table to run your home-based business, that's not exclusive, because I bet you eat dinner on that kitchen table. So you want to make sure that you have that you realize that the exclusivity of the exclusively part is really where things kind of break down for the home office deduction, because you have to be able to prove that you don't do anything else but do the business work there. So that's kind of the problem. But if you can take it, definitely do it. There's a simplified deduction, which really means you just measure the square footage and then you multiply that by $5, and that's your deduction. The full method means that you have to get the percentage of your house or apartment that is available for business, and use that business percentage as your deduction. So one's a little bit easier than the other because it's kind of like the standard mileage rate. Right? You just figure out how big a thing is and you multiply it by $5. Another really important expense that people often ask about is meal and entertainment. So the first thing to know is that entertainment no longer deductible. The Tax Cuts and Jobs Act did away with that. So no more entertaining and writing that off. That doesn't exist anymore. But you can still deduct meals. So 50% of the cost of business meals for you, for food and beverages, as long as, again, it's not considered lavish or extravagant. And then this, again, also, as I mentioned before, does have its own specific record keeping requirements. You have to be able to name the current or potential business customer or client, the date, the time, what you discussed, and how this might be able to further your business. So it's the record keeping requirements around meals is a little bit more laid out than other records are. So you have to make sure that you meet those record keeping requirements. But again, entertainment expenses no longer able to be deducted anymore. So you can't take people to shows or purchase season tickets or anything like that as a way to drum up business. Those things have gone to the wayside. All right, so let's talk about estimated tax payments. These are payments that are made on income that isn't subject to withholding anywhere else. So whenever you think of being an employee, you know that your employer is withholding taxes for you on your behalf and paying them over to the government. However, when you work for yourself, no one is withholding on your behalf. You're the person that needs to do that. We are a pay-as-you-earn country, so that means that every time that you earn income, theoretically, you're supposed to be paying money over to the IRS on all of the income that you earned. So if you are getting money on a weekly or biweekly basis, theoretically, on that same weekly or biweekly basis, you should be paying over to the IRS. However, when you're a small business, that's a little bit more, that might be a little tedious or not. But either way, the IRS decided that they would allow you to make quarterly payments so 4 times a year, and so that you can ensure that you are paying as you're earning. Because if you decide, if you're earning money the entire year and then you just pay at tax time, you will actually get charged interest and a penalty because you waited 12 months. You waited that whole time to make payments, whereas you're supposed to be making payments as you're earning. So you don't want the IRS to charge you interest and penalties on that. So that's why estimated tax payments were established, so that you could make those payments in a timely manner. So the idea is that you pay for each period, but these are kind of thoughts that might be a little bit antiquated. They're based on accounting principles, so that you pay for every quarter. So for the first quarter of every year, you would pay for April 15th. Now this year, because of the coronavirus, the IRS pushed back quarterly payments to July 15th, but now we're pretty much on the regularly scheduled business. So next payments were due September 15th, and then January 15th or the 31st of the next year. So if doing quarterly estimated tax payments makes sense to you, totally do that. But for a lot of our clients, we see that it makes sense for them to think of this as a bill. So they rather pay it on a monthly or bi-weekly basis because they remember. A lot of times folks don't, like I said, they forget about things happening. So, they don't remember every 3 months that they need to make a payment to the IRS. But you can remember once a month, right? You think of it like the electric bill. Yeah, I'm going to pay the IRS this month, just like you would do any other bill. If that helps, keep that in your brain, then make sure that you can do it that way too. The IRS is really happy to take your money whenever. So, just make sure that you are paying if you can. The same thing happens for Maryland. There's a quarterly tax payment schedule for them too, but you can definitely make these payments as, it makes sense to you if that's a weekly or a monthly basis. The important thing is that you want to make these payments if you can, and you can make these payments by mailing in the forms, or you can set up a recurring payment online, or you can just go online and make the payments like once, however you want to do it. A lot of people get stuck on how much they have to pay because it's a pretty ridiculous formula that the IRS kind of puts forth to try and figure out how much you're going to earn in the year. It's a little tough, but if you kind of have an idea of how much you're going to earn, or you want to see what it looks like, you can use our simple estimated tax calculator. We worked with the Center on Budget and Policy Priorities to do some work for rideshare drivers, and we came up with a simple estimated tax calculator. All you need to do is enter your filing status and how much self-employment income you think or project that you're going to make. And sometimes what you really want is to see, how much do you have to pay in a monthly or quarterly basis, and this will help you figure that out. The address for that is at the bottom of this page. It kind of just helps you figure out, if I make $10,000 in the year, how much should I be paying? There is also a more advanced estimated payments calculator that goes more into your personal life to help you figure out more exactly what that would be. But using the simple estimated payments calculator is fine. The idea is that you want to be making payments so that you don't get charged any interest and penalties for not paying and earning money throughout the year. So here's the success story from one of our clients. We talked to Maria S. about making estimated tax payments and doing a better job about keeping her records. And then, the next year she was able to make 11,250 payments. She figured out what were some qualifying expenses and kept all of her records, and she was able to receive a refund of over $1,000. So this is a success story for us. She came to one of our classes, we talked about estimated payments, we talked about qualifying business expenses with records, and she did all of that. And she had been in a situation with the IRS before and was now able to get a refund and hadn't been charged any interest and penalties. This is where you want to be, folks. That's a good success story for us. This can be you too. All right, so I'm running out of time. So here's our quick top 10 tax tips. So number one, you want to maintain a separate business account for your business. It's one of the easiest ways to prove a profit motivation is the fact that you have a separate business account or credit card for your business. Remember, we want to distinguish between hobbies and businesses so that we can always deduct our expenses. Tip two, you want to save and organize your expense receipts by category for easier review when the time comes. Tip three, you want to make tax planning a monthly activity. Don't wait until next year to figure out what your tax situation is. You want to be thinking about this stuff on a monthly basis. Tip 4, if you're someone who drives a lot, you always want to track your business mileage. It's one of the easiest expenses to account for, especially if you're using that standard mileage rate. Number 5, literally have anything handy. So a calendar, a notepad, get your mobile app ready so that you can easily notate any expenses. Again, you don't want to miss stuff because it's really hard to reconstruct your expenses later on. So make sure that you have any one of these things available with you at all times so that you're able to annotate any expenses or things that you might have purchased. Tip 6, keep track of all of your business income, including any cash payments received. Remember, the IRS doesn't just care about your expenses, they want to know about your income too. So even if it's cash and you don't get a receipt or an invoice, make sure that you keep track of it in your records. You're responsible for all of your business records. Number 7, make estimated tax payments to the IRS and the Comptroller of Maryland as you can. You can do both of those things online. You just want to make sure that you're not waiting until the end of the tax season, because by then you're accruing interest and penalties no matter what. You want to at least show that you've been making some payments, even if it's 20 bucks here, 50 bucks there. Tip 8, make sure you file both your federal and state returns in a timely manner. So usually that's April 15th, unless you're in DC or Boston. Sometimes sometimes it ends up being the 18th. And then this year was, because of the coronavirus, it was July 15th. But it's, for the most part, it's in April. You want to make sure that you're filing on time. If you need to request an extension for an extra 6 months, go ahead and do that. It'll change the time period to October 15th. But you just know, even if you file an extension, it doesn't mean that it's giving you more time to pay. It just means that you're taking more time to file a tax return. So you still have a failure to pay penalty if you owe taxes, even if you filed an extension. All the extension does is relieve you of the failure to file penalty. So keep that in mind. Tip 9, realize when you may need a professional. There are times when this stuff gets overwhelming and you might need someone to give you a hand, and that's okay. Asking for help is never wrong unless it's too late. Even then it's not wrong, but still too late. So realize if you're in over your head, if bookkeeping is taking on way too much time, or you're not doing it at all, it might be time to hire someone or seek some assistance. You want to know more on the front end, than ever. You don't want to be realizing too late that you're in too deep and need some real help. And number 10, you want to save all of your tax documents for at least 7 years. And even, I hear these different time periods, 3 years, 6 years, I say 7, but the reality is the IRS can come audit whenever they want, especially if they suspect you of fraud. There is no statute of limitations on that. They can come and open your books up from 20 years ago. So you just want to make sure you can hold on to your documents as long as possible. We've now got Google Drive, Dropbox, Box, Cloud, all this stuff. All of it is uploadable and it's not boxes and boxes of paperwork anymore. So just hold on to your stuff for as long as you can, is my advice. All right, some other helpful tools and resources. We've got the EITCoutreach.org rideshare stuff that we created. It's really designed for rideshare drivers, but it's got some helpful information. The IRS has developed their Small Businesses and Self-Employed Center. There's a bunch of different publications that you can check out to get more information. And if you have any questions, definitely put them in the chat box. Like I said, this is a pre-recorded workshop, but I am here and ready to answer your questions. I really love being able to share information with you guys. So make sure that you're chatting your questions and I'll be here to answer them as I can. Thank you all so much for joining me today for the Small Business Tax Bootcamp. I hope this was information that you needed and wanted and was helpful, and I will see you all next time. Bye.